You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by our special guest, Joe Value, who goes by the username @JoeValue on Twitter, for those of you that don't already follow him. It is the 29th of April, 2023. Joe, firstly, thank you very much for coming on the show as a guest. If you're happy to just jump straight in, could you just tell us a bit about you?
Oh yeah, thanks for inviting me, Sam. So starting at the beginning or ish, I'm a maths graduate, I've got a master's in maths, and then ended up going down the route of becoming an actuary, starting at KPMG and then various other bits. I've been doing that for like over 10 years. And then I've always been interested in investing and the financial world and all that kind of stuff. So, I was the kind of kid at A levels reading the FT and that kind of thing. Super cool. At university, I was playing around with, stock accounts, non-live ones, trade, paper account. And then I kind of got into work and, all that actuarial stuff, which is great, like risk management, calculating risk and stuff. For those who don't know, actuary is basically someone that, calculates financial risk for insurance companies and makes sure that they have enough money in a pot to pay out on insured events. So that's kind of my background. And then during COVID, when the market was going absolutely crazy, I was just looking at it kind of just made me come back to investing and wanted to read up what was going on. And also just with the oil price, that was the thing that really drew me in, with the oil price going super low, below cost of production. I just thought, this is absolutely insane opportunity. I've got to buy some oil and I've got to figure out what's going on here. So me and a friend, Swapnil Singh, we ended up just going full on into value investing and reading all the books and reading Warren Buffett and Joel Greenblatt, and basically ended up being obsessed with the stuff that Joel Greenblatt was saying in his lecture notes and in his books. And I'm kind of just gone from there. So then 3 years later, I've been running a fund for just over a year, and it focuses on special situations. And that's pretty much where we've got to. We had some great years coming out of COVID. We had a 60% year and a 65% year, I think. And then last year was pretty difficult. Yeah, so and then going forward, we're just continuing to focus on special situations. We run the fund together, do all the research together. So that's pretty much it. Is there anything else, Sam?
Yeah, there's a couple of things I'd quite like to go back to. So when you say you were an actuary for 10 years, and then you basically became more you really got into investing in COVID. Were you doing any investing whilst you were working as an actuary?
Not really, not in terms of valuation, company valuations and that kind of stuff. I did try out various things, where you've got to go, what's Forex trading like, or what's, or just reading about some investments, just doing some small things here and there, but mostly it was just like funds or ETFs. But it wasn't I hadn't read tons of books on it. Now I've just read a book a week almost. So it's, it's getting through tons and tons. In COVID, I read sometimes 3 books in a week. It was
I thought I read a lot.
Audiobooks as well. I had a baby, and all she needed was just holding. So I just listened to audiobooks sped up, and that was yeah.
Wow. We'll see if she's picked any of it up.
Yeah.
So how did you end up becoming a fund manager then?
So I was sharing some of the investment research with friends and family, and in particular with my dad. And he had a contact who was a broker and discretionary manager, and he worked with my dad in financial advice and stuff. And he said to my dad, I don't really know how it developed, but I was having a chat with my dad saying, I want to do this full time. I want to start a fund. I want to do this full time. And we just came up with the idea of just asking him, this broker, if we could have a sub fund in his fund where he would manage all the admin and the legal side, compliance and everything, and do all the client contacting, putting on all the trades. And then I'd give him the research and he would just execute on behalf of the clients.
Okay.
The thing is that it's super difficult to get a fund going when you've got a smaller AUM. Like you really need at least 10 million AUM to justify the cost of going on your own. But this is a way that, we manage about 2.5 million. So the cost would be too high to go on our own. So this is a great way, a stepping stone, I guess.
So do you still work as an actuary, or do you do this full time now?
I do it about basically 50-50 because I've got a mortgage to pay and stuff. So I've got to keep the income going while I basically start this fund, which will take a while because I think, people are keen to see a track record, and I think that's the main thing, like a public track record. So it's at this stage, it's more difficult to find new clients, or new clients are being attracted to what we're doing.
So could you tell us just a bit about what your fund actually does? So I know you mentioned special situations, but on a day-to-day, what is it that your fund is actually looking for or looking at?
Yeah, so we've got a number of ways of researching new companies and looking at, using screens, using kind of news feeds and Google alerts to find what's going on in the market and if things are changing. So the kind of things that we're looking at is, mergers, acquisitions, spin-offs, liquidations, bankruptcies, something like internal change going on within the company, some kind of capital structure change or whatever, and kind of, looking at the whole is not just quantitative. It's kind of, some kind of internal event going on in the company, but particularly we're looking at, the small cap side, just kind of areas where there's less people looking, I guess, the less people fishing in that pond. So it kind of makes the market that we're looking at less competitive, less efficient.
Is it predominantly UK markets?
No, it's global. So
Okay.
It's really global. Any kind of things where there's forced selling is great. That's a great one where, people have to sell. I think we'll probably get into it later, but one of the big ones was Garrett Motion, which is a turbocharger company. They voluntarily declared bankruptcy due to a legal fight around their debt, and the business was actually fine. It was just that they had an argument about their capital structure, and so when they go into bankruptcy, all the funds and all the ETFs and stuff, they're not allowed to hold equity in companies that are going through a bankruptcy, so they have to sell. So obviously just the share price plummets, and it just massively undervalued the actual quite strong fundamentals of the company. So that's the kind of thing that we're looking at.
Okay. So how do you actually find these? Because I'd have thought even if it was just in the UK, I mean, I find small caps just quite difficult because you don't really know anything about them going in, which I know is like in some ways an advantage because, like you say, you're looking where less people are looking. But to then do that in another market, how does that compare to the UK ones? And does that make it more difficult?
Yeah, I mean, you're right. It takes a lot of kind of looking in a lot of places and kind of keeping track of a lot of different companies, and you're never going to get all of them. There's just too many. But what I like about particularly looking in America is the company governance and stuff is quite strong. The reporting element of that is quite strong. So it's kind of, there are maybe a couple of people that pick up on things, and then you kind of, if you're following the right people, you can maybe get in early as well. I don't know. It's just keeping an eye on lots of things that are going on, and also Google alerts. I think you can get up to speed with the company pretty quickly as well if something's going on.
Is it only English speaking countries you look at?
So far, yes, but I think really would be good to do some non-English speaking countries as well.
Okay. How do you find running the fund in terms of the differences, if there are any psychologically, between managing your own money compared to knowing that the money that you're managing is someone else's?
Good question. I think I'd just be a bit more cautious with other people's money, and just make sure that there's this kind of less concentration, more diversification there, just in case things do go wrong. So basically how I think about it is that our clients are high net worth kind of clients, and they have other portfolio, like that. This is a small part of their portfolio, so they have, ETFs or they have funds or whatever, and they're very happy with that. And then they maybe put 10 to 15% of their portfolio into our management. So I think what I'm trying to do is I'm trying to provide access to these individuals to have exposure to something that's a bit different and a bit more, focused on special situations, which is good because often they're quite uncorrelated with the general market movements. If you're looking at liquidation, if there's a big downturn in the market, often they're kind of quite stable and unchanged because the valuation, they're selling off land or whatever, it's less volatile. So it acts as a bit of a diversification for them. So I do like, what I'm saying is that I kind of make sure that we're focused on what we're saying we're going to do rather than, personally, I might look at some other bits that are, maybe just pure value, like interesting to me, and I might invest in that, not kind of completely on strategy. But basically, I do invest my money in almost identical ways to the fund.
Another thing that I've just thought of now. So we met at the Fundsmith AGM.
Yep.
Do you own any shares in Fundsmith? And if not, why did you go? And do you go to any of the others?
So I don't own any Fundsmith. I did. Yeah, I feel like Fundsmith's kind of a bit like a Berkshire Hathaway type event in England, and I wanted to go to Berkshire Hathaway, but it's a bit far, and I don't know. I think there's. I mainly I went because I wanted to meet like-minded people and have a good chat, and we had a great time, and had a few beers before and afterwards, and had some really great chats with everyone. So that was my main purpose of going, and yeah, it was interesting to hear Terry Smith speak, and I was very impressed with the way he did speak, and his kind of, I want to say, it's the CEO is kind of like quite a big salesman type pitch of his fund. I just wanted to see how he put that across, and we did that very well.
So is that the first one of those that you've actually done? You've not done any others?
No, yeah, that's the first one, yeah.
Oh, is it? That was our first one as well, actually. I was also, so I was pretty similar, actually, in that I've always wanted to go to Berkshire, but I just can't really justify the costs. And like, as well, it's just like going to Omaha for like what would be a few days just to go to one meeting, and like the time zone's completely different. It's just not, practically, it's just not very good. So me and John decided we were going to go to Fundsmith, and we just thought we'd see if like anyone else would go. But yeah, we had like a decent group. We had like 10 or 11 of us, which we weren't expecting. And then as well with the, I was just, one thing that did surprise me was because we treated it the same, almost like a mini sort of UK Berkshire. And we'd gone, and I didn't expect there to be anywhere near as many people as there actually were in that meeting. I was absolutely stunned by I know it was nowhere near the scale of Berkshire, but even still, the fact that many people will go to hear this guy speak, I think is quite impressive.
Yeah, it was. Yeah, and it was a great atmosphere. Yeah, it was really nice to meet everyone. And I kind of, that's one of my goals at the moment, is to build a network of other investors in the UK and do some meetups. And I've got a little Discord channel with some people that are investors that are interested in meeting up in the UK and just having a chat. Because I think it's obviously great sharing ideas on Twitter and that kind of thing, but actually meeting up in person is something a bit special and just nice to get out. So yeah, I mean, if anyone's interested, you can message me on Twitter and I'll add you to the group. But I'd not meeting regularly, but just every so often.
Whereabouts do you live?
So I'm based in Birmingham, but I have family in London as well, so it'll probably be in those kind of two locations.
Okay. So have you done any other meetups?
Well, I've done one in Birmingham as well, so yeah.
Okay.
I need to get going. I need to do more, to be fair.
Right. If you're ever doing one in the Northeast, let me know. Otherwise, I'll just give you a shout if I'm ever in Birmingham again. I was there like a year ago. I would go back, actually. Anyway, so could you talk to us a bit about your investment appraisal process and how you approach looking at a new stock or potential investment? And I'm assuming that this process is, based on what you've said, basically the same, whether it's in the fund or your individual portfolio.
Yeah, that's right. Yeah. I mean, it's kind of, two birds with one stone, really, because I'm looking for investments for me and for the fund at the same time. So I get the idea wherever it comes from, whether it's from a screen. Like, I guess with a screen, you're going to be more killing the idea very quickly, just because you've screened for it. So it's just looking at, how cheap it is, what's going on there. Is there kind of something, internal change going on or some kind of special situation? And then if it's kind of more of a recommendation from like a network of investors that I speak with, then I might take a bit more time because they've obviously found something interesting. And then, so I think for me, it's often more quick look at the fundamentals, check if there's nothing very concerning there. And then it's looking at, okay, well, what's the story? What's the angle, the qualitative side of it? And then trying to understand the thesis, basically really distill it down to like maybe 3 bullet points of like, you're looking for 3 things to happen, or the most material things. And then once you're happy with that kind of thesis and you think that there's, a small downside, I guess, then doing some more like valuation, really digging into their annual reports and building up. I like to use Bruce Greenwald's method for valuation. He's been teaching value investing at Columbia Business School for decades, and he trained like Lilu and stuff like that. So he's an amazing guy, and he's not a practitioner, but he just teaches there. And his earnings power value is great, and there's a great way of triangulating valuation that he lays out. And then like just doing, depending on the situation, looking at a simple DCF. I really don't like to go into like a lot of assumptions because I just like to do it kind of pen on paper, very simple models. But the great thing about Bruce Greenwald's method is that there is actually very, very few assumptions that he uses. It's mainly driven on the existing company data. And I use Ticker, which is great for looking at the financials of different companies. And then I have a big chat with my business partner Swapnil. We go through it and we look at the valuation. We're mainly focused on the downside first and killing the idea as quickly as we can. And then once we've agreed that kind of the downside's quite low and the upside's decent, then we'll just continue researching it, looking at competitors and looking at the whole situation. And then don't try not to rush into it. Try not to get like too excited about things. And then like within maybe a week or so, we'll come to a decision and start buying, I guess.
When you say start buying, how long would it normally take you to build up a position, or would you just do it in one go?
It really depends on the size of the company. Some of them are illiquid, and then we just have to see how many shares we can get each day, put a limit buy order in or something like that. Stay quite patient and not try and move the price up. So some of them do take, a long time to build a position, and some of them you can just go, oh, well, let's just average in, like do 3 or 4 buys over a few week period. It depends on the situation as well, because if it's quite a time sensitive one, as in they've just announced, that they're selling the company or something, then you just get as much shares as you can.
Okay. So you've talked a bit about, you said you're documenting your thoughts as you go through. How important do you think that is? And do you go back and then look at that later on to see if anything's changed and what to remind yourself what you were originally thinking when you bought it?
Yeah, definitely. Like, I think writing it down is really, really important. I suppose one of the steps that I missed was that I generally, so writing down the thesis really helps you understand what you know, and also kind of you write it down and you go, oh, do I know the answer to that? I'm not sure. And then you have to go back and figure something out. And so once you've laid down the argument like clearly and concisely, it really helps, for me anyway, it really helps kind of get it clear in my mind why exactly I'm buying this. And then the final step as well is to actually share it with some of the investor network that I've built up, to get some feedback on the idea. And normally that's really, really helpful, because people can pick holes in your arguments, and that's really what you want. You want people to give you pushbacks and then figure out why their questions are true or not true or whatever. And then writing it down, as I said, like really organize your thoughts, and then you can go back and look at it as well at some point. But I think the main thing is to write it down, and also that's kind of a benefit of building a model as well, is that it really helps you dig into the financials and makes you look for the right numbers, if you know what I mean. It's not it looks all right, I'll buy it. But yeah, it's that focus of writing it down that really helps.
I think I can guess the answer to this one based on what you've already said, but what's the best book you've read on investing, and how much do you read in general?
Probably my favorite book is How to Be a Stock Market, or You Can Be a Stock Market Genius. I can't remember the exact title, but Joel Greenblatt. That's just a brilliant book. And also his lecture notes from Columbia University are brilliant. So those in combination would probably be my favorite bits to read. And the reason why is because a lot of investors have really amazing advice and stuff, but what Greenblatt does is he teaches stuff that is directly applicable to people with smaller AUM, and the strategies no longer work for him because it's got so big. But it's that targeted advice to people in my kind of situation is exactly what I want to know. Where to look, what kind of things to look for, and he's just a great teacher as well, because he actually wanted to be a teacher. If he wasn't a fund manager, he'd be a teacher. So he really does want to pass on the knowledge.
How much do you read in general, and how much of that reading is basically exclusively to do with investing versus more general reading?
I read all the time, like, I'm just obsessed with reading and learning, and it is all to do with investing. I mean, I used to read, fiction and fantasy and stuff like that. But now I'm literally only interested in reading investing. Maybe it's too extreme. My wife always keeps telling me, "Oh, you should do something else. You should chill out a bit more." I'm just like, no, this is pure enjoyment for me. So yeah, just reading whenever I've got spare time in the evenings, even sometimes during the day, and audiobooks as well. Amazing. Like, just going in the car, going to the gym or whatever. Just as soon as I get in the car, I put on an audiobook and I put it at like 1.5 times and just try and absorb as much information as I can. And a lot of the books aren't just around investing, but also around like human psychology and all the kind of peripheral bits that go into making investment decisions.
So it's not just pure investing books, it's anything basically where you think there's some kind of investment application to it.
Yeah, anything to help me to be a better investor, really.
I can't do 1.5x. I just don't take it in. I can only do audiobooks. I think 1.2x. I tried to get it up to 1.25 and I was like, no, this is too fast.
Yeah, sometimes it depends on the speaker of the audiobook, I guess. But but it sometimes you just kind of get into flow, and when it's that speed, I find that you kind of have to focus on it, otherwise you miss it. So it stops your mind wandering.
So yeah, I just don't do that. If I have it too fast, what I find is like I'm struggling to keep up. I start daydreaming for 30 seconds, and then I've just got no idea what's going on anymore. Anyway, so do you reread books?
Very rarely, and I've always I just kind of I think I've got quite a good long-term memory, so my short-term memory isn't that great. I'm pretty bad at like remembering like a sequence of long numbers, for example. But things that are, that make sense to me, they just kind of stick in my long-term memory, and then I don't really generally reread things. I have reread the lecture notes, and I've reread that favorite book, and I've reread some of the psychology books actually, because it's quite easy to forget some of the key points that they make. Yeah, so
I do find when a lot of the time, I think when you read something for the first time, it's like you might. I mean, my long-term memory might be and probably is a lot worse than yours. But like, I'll come away from reading a book and I might have really just retained like one or two principles from it. Like in terms of like, 6 months or a year on, like most of the details gone. So then if it like is a good book, if you do actually go back to it, I do find it just amazing how much you've just not even retained at all. That might just be me though. But
I get that, because I also I think sometimes they make such small points that you miss it, and once you've kind of had a bit more experience or learned something from someone else, then you come back to it and then it's like, oh, I didn't realize they were actually saying that. I think I may have misunderstood it the first time around or whatever.
There's a lot of stuff I find as well where it's like, especially with the investing book, if you go back to like books that you read in, say, your first year and reread them again now, you will just get so much more from them because you, like you say, you just, there's stuff that you just couldn't have picked up on because you were sort of focusing on the basics when you first read them. And then if you go back now, it's like, oh, well, actually, that's actually really useful. And I hadn't even clocked that at all the first time.
Yeah, that's exactly right. Yeah. Yeah. Whatnot rereads things all the time. But yeah, well, I enjoy having chats with him all the time about it. So he kind of reminds me of things anyway. So yeah.
Right, perfect. What are the best resources that you use for investing? And these can be free or paid.
So the best and only paid subscription I have is Ticker, and I really think that's great. It's very easy to get all the company data from there. I mean, there are sometimes a few mistakes or it doesn't pick it up right, and it's got all the transcripts there, and you can do screens and stuff. So that is really great. And then free is like Google Alerts, Twitter, audiobooks. So I just use all audiobooks from YouTube and then like the Lead Gen or whatever it's called, where you can download ebooks. And I had Kindle Paperlike or Paperwhite or whatever it's called, and that was great, but it was a bit small. So I've recently upgraded to the Kindle Scribe, which is really, really good. Definitely recommend that for people that do a lot of reading because it's just so much bigger, and you can read like PDFs and it doesn't mess up the formatting and stuff. And you can write notes as well on directly on the Kindle, and it saves it. So those are probably my biggest resources, and just building a network of other investors that I really admire and that share great ideas. So like just through Twitter, I've met some amazing people and just kept in contact with them, and I share my ideas and they share their ideas, and that doesn't always, like, often we end up disagreeing, but that's good. But occasionally you get a really great idea through that as well. So that's a free resource that you can generate yourself, I guess.
I actually don't. I've never been able to get into ebooks. I don't mind audiobooks, but I'm very selective about like what I'll actually listen to as an audiobook. I just don't like the ebooks. I quite like having them on the shelf. I quite like it, like adding them to it, and there's no real logic to it because it takes up more space and stuff. But I just do not like the Kindles. Not really any purpose to that comment. Just wanted you to know.
Yeah. I can just go to a cafe or the gym or whatever and just be able to take the Kindle in my rucksack, and then I've got access to like several books. I don't read like one book at a time. I read like multiple books in one go. So it would be a pain to like carry them all around at the same time and not know which books you want to read at that time.
See, I can't do that either. I'll have one physical book on the go and one audio book on the go for when I'm like driving or walking or something, and that's it. I just do them one at a time. Who do you look up to as an investor?
Obviously Warren Buffett and Charlie Munger, and then Joel Greenblatt and Howard Marks. I mean, there's loads, and like that the books that they've written and the things that they've said, just such incredible words of wisdom. Just keep coming back to them. But there's loads of others that are just I suppose those are probably the main ones.
What I know, it sounds like you might use Twitter more for just building up a network, but what are the Twitter accounts that you recommend following the most? And if you're not really getting quality content on Twitter, why do you find it useful?
Yeah, I think there are a lot of people that are like kind of lurking on Twitter and that are actually managing big funds or have tons of experience managing their own money or whatever. And when you kind of share ideas or you talk about a particular niche stock, they often message you directly and just ask you questions about it. And I think that's a great way to kind of, you put stuff out there and then people with incredible experience will come and start a conversation, which you wouldn't have been able to do if you hadn't have put content out there. So that's like, for me, the main benefit. And then, there are various kind of higher profile Twitter accounts that I follow, like Jeremy Rapier is brilliant for that kind of special situations. Had great success with one of his suggestions, which was Hunter Douglas, where he kind of took an activist role. And it's just interesting, seeing how some of the investors like Jeremy structure their investment thesis, and it kind of, there's a lot, Alluvial Capital, Dave is great there. And then it just kind of introduces me to more of their kind of annual letters and that kind of thing. And then also just staying up to date with like various trends that are going on and like what to avoid and what to go for. And the comments on Twitter are great as well. And all this stuff on AI as well, I found really fascinating because, there's massive productivity, like advancements to have there. So some of the Twitter accounts are great for that. Just seeing what other people are looking at. The trap is that you kind of end up scrolling aimlessly and then waste a whole load of time, which I often do. And I'm like, oh, damn it, why did I just like waste that 15 minutes or half an hour just like scrolling through and I've not done anything productive. But yeah, I think that's just a general social media trap, but it's worth it, I think.
Yeah, I find it less with Twitter. I think with Facebook, I've actually got rid of the app off my phone now. I just use Messenger because it's just I don't think I've ever spent 10 or 15 minutes on Facebook and come away thinking that was really worth my time. Instagram's a bit more like that, but I do quite like being able to see what people are up to. Whereas with Twitter, that's the only one where it's just like I wouldn't be without that. I just think it takes years to build up a good Twitter account is a problem. But like once you've got it to the point where you're following some really, really quality accounts,
yeah. I
think you can then the time I spend on Twitter, I almost view it closer to being productive because I have got some like interesting ideas off Twitter, and I've met a lot of interesting people. Like for example, most of the people that we've picked up for interviews on this show have come through like follows on Twitter and stuff. So I do actually find the Twitter very, very useful. What do you know now that you wish you'd known when you started investing?
I guess lots of things. I guess I didn't realize how important the psychological aspect of investing is and how it's so easy to get swayed by human biases. So it's just, focusing on that early on is important. And also just there are some things in books that they tell you like, you need a lot of patience as an investor, or you will find, don't do certain things, like don't over concentrate, which is something I have done in the past. And you kind of go, yeah, that makes sense, of course. And then when you actually do it, you're like, this is, you have to learn some of the lessons I think you have to learn firsthand. And I'm not sure I was aware of that. I think at the beginning I thought, oh, well, I could just learn everything from books. But I think there are some lessons that actually just have to be had from experience. But also, like, I had no idea how fulfilling it would be to be an investor and to be doing so much learning. I think, all the things I've been learning as an investor have been, very transferable to like the rest of my life and to the way I want to live and the kind of person that I want to be. And I know that sounds a bit big, but it really has made a big impact on, the level of interest and learning that I've had, and also the way that I want to be with people. Yeah, so I had no idea that investing would change my life in such a big way.
This links on it's a pretty similar question, but how have you evolved as an investor over the time you've been doing it?
So I think, one of the first things we started with was looking at a magic formula and, that Joel Greenblatt produced. And that's just a purely quantitative screening type approach, investing approach. So kind of going from thinking that, fundamentals are the most important thing and that, you just have to choose things with high yields and high return on capital, to kind of going, well, actually, probably the place where you find the most alpha is in the qualitative stuff, as in like looking at not just the numbers, but what's actually going on with the company, how the incentives is structured. And I think there's a quote from Charlie Munger about incentives, so something like, show me the incentives and I'll show you the outcome. And it's so powerful, that, because how are the board incentivized, how are the management incentivized, all that kind of stuff really massively impacts the way that businesses are run and the results that happen. So I think, yeah, it's more of a focus on the psychological side of investing that I'm coming to more.
Right. So we're about halfway through the questions, with the rest of the questions more about, how you're actually investing in your portfolio and some of the stocks in it. So I think for part one, that this is probably quite a good place to draw it to a close. Firstly, thank you very much for coming on the show. And where can people go if they want to find out more about you or your fund?
So the main place to go is Twitter at Joe Value. and just my DMs are open, so just feel free to message me. Yeah, that's what I'll say. And I also do have a Substack if you want to read some of the theses that I've put out.
Where's the Substack and what's it called?
Substack is called Special Situations Global Equities, and it's linked in my bio on the Twitter account.
Okay, well, thank you very much for listening, everyone, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.